Microsized earnings approach. I mean, we just got through earnings season, but we are quickly approaching the next one here in December. So we'll talk through some of that here. Let's do it.
I'm ready.
All right. So approaching earnings is typically coupled with levels of increasing volatility based on 15 years of data. We're looking at the Qs, the five largest holdings using the standard deviation of price from the average day to the earnings day. We find that volatility typically increases by about 4 times on an earnings day. And so, this is just a very basic discussion on expecting volatility into earnings. When you have these binary events, volatility is going to be a multiple of what you typically see in the market as a whole. When you're looking at Apple going into earnings, it is very high relative to the rest of the market volatility.
Yep.
So earnings as an engagement trade. So it provides opportunity for many occurrences. Of course, they're non-standard short-term trades. So these are kind of binary events that you're trading around just as kind of a short-term trade. They differ from the core strategy and look to profit from a contraction in volatility. If you're selling premium, you can do that with a directional component as well. If you're doing diagonal spreads, calendar spreads, stuff like that.
I like it.
Next slide here. So one approach that we look to do is define the risk. This can substantially reduce margin and potential losses. It can also allow for high number of occurrences and high probability trades. So you can, put on small amount of risk, get that engagement trade on, and have that, instant pain or instant gain. I think that's the one thing you gotta keep in mind here. Undefined risk is also on the table here. We try to keep position size 5% of our net lick or lesser with those undefined risk trades in general. So just keep that in mind as well. I mean, earnings give us that volatility that we're looking for.
Okie dokie.
Statistically, we can create earnings iron condors with similar pop and win percentage as a standard 45-day trade. So when we look at SPY, all the occurrences, the win rate of an iron condor is roughly 73%. When we're looking at like a 20 or 30 delta short option, it's kind of the same thing in earnings. Despite the big tail risk that you have to keep that in mind. The earnings event, a lot more max losses come into play than typical 40, 45-day trades. So you got to keep that in mind when you're trading earnings. Next slide here. So the strategies we choose will vary based on the assumption, but generally speaking, part of our normal trading approach, if you're looking at bullish trades, short puts or put spreads, bearish, short call spreads, of course, iron flies, iron condors, those are on the table if you want that neutral delta. We do a lot of diagonal spreads, calendar spreads, all those things are on the table into earnings.
Of course.
Next slide here. So this is just like general setup for, how you can place an earnings trade. And these are small sized trades. So if you're in a Johnny Trader account, this is a general idea of what you should be looking at. $5 wide iron condors, you're collecting, 25 to 50% of the width, depending on how much risk you want on. This is just basically a basic example of kind of earnings trades here in a Johnny sized account.
I love it.
And this is what the risk profiles look like. So if trading a risk-defined iron condor, consider using the natural skew in the market and choose strikes dynamically. This is what we call a dynamic iron condor. So if you're selling a 20 delta put and buying a 10 delta call and put to define the risk, that is a delta neutral trade. We did one in the Qs this morning where we had a 20-point wide put spread by a 10-point wide call spread. It plays into the natural skew of whatever that underlying is. The NASDAQ and ETFs in general have that put skew. A lot of time with earnings and tech names, you'll see that call side skew. And so you can adjust it that way as well. If you want to be truly delta neutral, you could do that dynamically by doing the same delta for the short and the long options.
Beautiful.
Next slide here. Here we go. Did we get our
Yeah, you're 24,000 on the Nasdaq futures. That's been your weakest of the group. Weakest of the group.
93.
Say again.
I'm in at 93.
Awesome. Even the S&P down
23,
5
993.
to 65.50.
For earnings, you can see where the earnings are coming up on the trade page here. So it's that purple line that you see. The bell icon will dictate whether it's before or after the bell. So here, December 10th, after the bell. So you have the bell and then the arrow. After the bell, if it's before the bell, meaning before the open, you'll have the arrow pointing to the left side. So it'll indicate whether it's before or after the bell here.
Got it.
Next slide here. So the expected move is a way to dictate our strategy. So with higher, wider, bigger expected moves, higher volatility, obviously the premium is going to be juicier. It's a good reason to define risk as well. If you want to do that, if you're kind of afraid of that risk, lower expected moves, I say just kind of avoid those underlyings altogether, but you might choose a different strategy.
Beautiful.
Last slide here, a couple takeaways. So earnings allow us to increase our number of occurrences. I call them engagement trades. If you're doing them if your normal size of a trade, a 45-day trade is, 10 contracts, I say do earnings at 2 contracts.
Right.
That's the sort of trade that these earnings events are. They are smaller engagement trades. You have to keep in mind they're going to be instant pain, instant gain a lot of the time, especially if you're using those shorter duration options here.